Welcome to the DIY Wealth Canada podcast, a show by independent investors for independent investors. Join hosts Bob and Nelson as they discuss investing, personal finance, and much more, all from a fiercely self-reliant Canadian perspective. As a reminder, nothing you're about to hear is investment advice. Thanks for listening and enjoy the show.
Hey everybody, welcome back to another episode of DIY Wealth Canada podcast. I'm Bob. Along with me is my co-host Nelson. We have a good one today. Well, we say that because we do. We're going to talk about living off dividends. Both Nelson and I are dividend growth investors with our goals of living off dividends one day. Actually, Nelson's already doing that, but I'm hoping we could do that in the near future. But we wanted to cover really living off dividends, the good, the bad, and ugly, right? Living off dividends isn't always nice. There could be some stuff that you may want to consider because it could get a little bit ugly. Nelson, are you excited about this?
Yeah, I am excited I'm always excited to talk dividends. I think this is a important topic. I've been reading a little bit lately on kind of retirement, decumulation, making sure you have enough money in retirement. And the more I read about it, the more I think that it is just one of the, if not the toughest financial question that we will ever have to encounter. And on this episode, we're going to talk about how dividends can be part of that. They could be all of that, and the good, the bad, and the ugly of that plan. So I think it's an important one for anyone who has the plan to ever live on dividends at some point to listen to, and I can talk a little bit about my experience as I went through it as well.
Yeah, so let's just get to the basic of living off dividends. The idea is to basically build up your investment portfolio such that the dividends you get can basically cover your living expenses, right? So a good rule of thumb, similarly to the 4% withdrawal rule, is that you have enough dividend that enough portfolio to yield about 4% of dividends, right? So, and then the idea is once you have enough dividends, you live off from it and you don't have to sell your capital. So essentially you would never run out of money. Now, in reality, maybe 4% is too high, somewhere around 3% or even sometimes 2%. That's the comfortable spot. Yeah, so that's the basic of it.
Yeah, so dividend yields have come down over the last, let's call it like kind of 10 to 15 years. Companies are more inclined to potentially do share buybacks or pay smaller dividends than what they have been before. And for a lot of companies, it was a growth thing where it was like, you're a tech company, you want to reinvest your earnings back into the company and grow the earnings more and more. But what we've seen, especially I'm going to say since 2020, is that tech companies are, on the whole, there's always going to be these unprofitable ones or these ones with extremely high valuation, but on the whole is tech companies are extremely profitable. And there are a whole bunch that just do not prioritize dividends at all. And they're not really pouring a lot of money to reinvest back in the company, at least up until this year when AI narrative took over and a lot of that money is now being reinvested into data centers and AI and et cetera. That's first of all, one of the issues with retiring on dividends is that dividend yields have gone down over time and there just aren't as many companies to kind of choose from that there used to be anyway. But let's talk about the positives maybe first before we talk about the negatives. And I think the biggest positive is that there's no decisions that need to be made in terms of your retirement at that point. It's just the money comes in, you spend it, and then the next year, hopefully, if you've done it, you have a dividend growth portfolio, more money comes in, and then you get to spend it. So it's a very easy way to go about retirement. There's not a lot of decisions that need to be made. You just hold. You might have to switch a stock that isn't working, but it's just a very hands-off, very simple strategy. Bob, would you agree with that? That's a really massive advantage, or is that something that I know the financial advisors out there would say that's extremely overrated? What do you think?
I think I really like that idea. It's just you just use the dividends that you receive and pay for your expenses. Now, the financial advisors and some people will say that dividends aren't free money, and yeah, that's true. But getting paid, it's a lot nicer than having to have making decisions on which one to sell, especially if you hold individual dividend stocks or individual stocks for that matter. And the other question, even if you're selling, is like, when do you sell? Like, you never know when the market is high or low. And it's just nice to have that steady cash flow from dividends. So makes your decision process a lot simpler. I think that's definitely one of the positives from dividend growth investing.
Yeah, I think another positive is that it's the way that most dividend growth stocks work is that you get to a certain stage in a company's life cycle. You go from this startup to this growth company to something that's a little bit more mature. And then, of course, from there, then you would perhaps like into the decline stage. But when you pick proper dividend growth stocks, and I can already hear the naysayers, oh, that's not very easy. And I don't think it is an insurmountable obstacle for a smart DIY investor, but you end up owning the kinds of stocks that do better during downturns and then maybe lag the market a little bit during bull markets. That's really a trade-off that a lot of retirees will happily make, because generally those stocks tend to be a little bit less risky than their kind of growthier counterparts, and they hold up better during bear markets. I think ultimately one of the biggest risks of retirement is what happens when the market crashes. And there are all sorts of strategies you can do to minimize that. But I think a really simple one is to just load up on the kinds of stocks that generally do better than the market as the market is going lower. Bob, do you find that in your portfolio? Like, as the market is going down, where we've just been through a bit of a downturn here in markets, like I know for sure that's what I found, was that my stocks were not down nearly as much as the indexes overall. What about your portfolio?
Yeah, I would say that's generally speaking true as well. We do own a little bit of energy stocks, so that's been the kind of the positive out of this little downturn. And yeah, we have some technology stocks or index that got hit quite a bit. I think overall, when I was looking at our portfolio the other day, we're positive year to date, and we're actually outperforming the TSX, the NASDAQ, and S&P 500. So I was a little bit surprised by that. So yeah, I think generally speaking, it's true. So I also think that with living off dividends, again, I think the mental side of things is very important, especially in retirement. It just makes your life a little bit simpler. You don't have to make that selling decision. You could just build up your cash reserve and then utilize that. It also gives you option. Not only you could spend your dividends, if you really need additional money, you could sell your principal and supplement that income if needed. Right? Most people may not need that, so they end up just using their dividends. So that's a positive.
I want to add probably the biggest positive is the rate that dividends are taxed in this country, especially when you don't have any other income. And I share this on Twitter, on X, on a regular basis, because it is just something that a lot of people do not believe. And I've said this before, actual accountants come up to me and they say, there's no chance that dividends are taxed as attractively as what you say they are. And then they go and they run the numbers and it's, oh yeah, you're right. So if you don't have any other income, you can make it's pretty much guaranteed in every province that except for Quebec and Nova Scotia, they're two of the outliers, but $55,000 a year in dividends, tax-free, as long as you don't have any other income. And in terms of like Alberta, BC, Saskatchewan, and Ontario, which are the four friendliest provinces in terms of retirees on dividends, you're looking at something like 65 to 70,000, depending on the province and some of the other stuff that is going on. You can earn without paying any taxes on that. And then of course you can income split with your wife. And I don't mean income split in terms of you have to have the investments in her name, your spouse's name, but you can also use that strategy over time. And it's really not that hard to, as you put $1 in your account, put $1 in your spouse's account and let them grow together. And so you can use a very simple strategy to get to the point where you and your spouse might be making $40,000 or $50,000 per year. As you enter retirement, you get your CPP and your OAS on top of that, and your tax burden at that point is extremely low. So you would keep virtually every dollar that you get from dividends as a Canadian retiree. It honestly feels like a cheat code. It's so good. And it was definitely a factor in terms of, my financial independence journey, looking at it from that perspective. Bob, do you have anything to add on that? Was that a driving factor for you as well?
Initially, no, we didn't realize the tax aspect, but yeah, I think the idea of not having to sell things was definitely very attractive. I just happened to check the tax rate. I'm on taxtips.ca.
Excellent website, by the way.
Excellent website. So just looking at the federal side of things, because provincial is a little bit different. So in 2026, before I get into that, so there's two different types of Canadian dividends, so eligible and non-eligible. Eligible dividends are way more tax efficient than non-eligible. What's the difference? Non-eligible dividends are usually paid out by income trusts and REITs. And because like REITs and income trusts, they always just directly pass their earnings down to shareholders. They don't pay taxes first. So the dividends that you get or distributions you get are not already taxed. So therefore you get taxed a little bit higher than eligible dividends. Eligible dividends are paid out by corporations like TD, the banks, the energy companies, where when they get earnings, they pay taxes first, and they distribute their earnings to the shareholders in the form of dividends. And that's why you get taxed a little bit less, right? So there's a difference between eligible and non-eligible dividends. And that's why you really should only be investing non-eligible dividends stocks in your TFSA to avoid the old tax things. But we're only talking about non-registered here. And if I look at this federal tax rate in 2026, the first $58,523, if you earn an active income, is taxed at 14%. Capital gains are 50% of that. So your capital gains when you're making this first tier of income is 7%. When it comes to Canadian dividends, now you get taxed 5.72%, still very low compared to active income and capital gains. Your eligible dividends, you're getting taxed at minus 1.41%. So you're actually getting some money back from the federal government. Right now, if you go up to the next ladder between $58,523 to $117,045, your active income, again, this is the ladder, right? So it's once you hit above the 58,523, your active income is taxed at 20.5%. Your capital gains half of that, so 10.25%. Your non-eligible dividends are taxed at 13.19%. And then your eligible dividends are taxed at 7.56%. Again, you can see how tax efficient dividends can be, regardless whether they're eligible or non-eligible. Yeah, you could essentially, if you structure your retirement income, you could essentially pay no tax, which is the beauty of living off dividend.
Yeah, I'll add quickly that the non-eligible, that's often when you have a small business and you're paying yourself as dividends, because small businesses get that preferential tax rate. It's basically just an eligible, if you're investing passively in a stock on the TSX, for the most part, they are eligible dividends. So when you're getting to REITs and things like that, it is different, like Bob said. But like if a company is paying you a dividend, if it does not come with that .UN qualifier on the stock exchange, then you're getting eligible dividends. So got to keep that in mind as you're looking at the difference between eligible and non-eligible. I know one of the criticisms of dividends, I always hear it, is that we'll have fun paying taxes on the dividends as you get them. And yeah, like I absolutely pay taxes on the dividends that I get outside of my RSP and TFSA. And I'm happy to do so because one is the tax rate is so low. Even as someone makes additional income, and it even it ratchets up from there in terms of the tax brackets and everything. But like even at the top tax bracket, dividends are still significantly more tax efficient than your employment income. So it's income that you're getting that you're taking out at a preferred tax rate, and then you have the optionality of that income where as you are in the accumulation phase, you can reinvest that, you can take it out and make a big purchase, you can do whatever with it. So there's that flexibility that exists no matter where you are in the kind of like your own personal finance journey, where if companies retained every penny that they made and they didn't pay those out to shareholders, you would have to make a decision on what to sell in order to get your money back out, because there'd be no other way to get your money out short of borrowing against your portfolio, which is probably not a good idea. So that's another thing I love about just dividends is the optionality of getting cash in my account all the time. I can use it to diversify away from a company that I might think is overvalued. I can use it to buy something that I think is undervalued, and so on. It's just that stream of cash gives you so many options, and I think is just such a underrated part about having a dividend.
Yeah, another thing to add is because this steady cash flow, you don't really have to worry about what the market is doing, right? If the market is down significantly, as long as you're still getting paid, you don't have to sell your portfolio. You still have that cash flow, which is nice. I guess regardless whether you're in retirement or not, even when you're accumulating, I just find I don't pay as much close attention to how the market is doing. Yeah, if the market is down significantly, so what? I'm still getting paid by dividends. As long as you don't see any dividend cuts. Now, we went through that during COVID, and that's why you need to construct your dividend portfolio by holding different dividend stocks across different sectors, and there's lots of stuff you could do to protect yourself from dividend cuts, right? But I think that's one of the positives from dividend growth investing or living off dividends. Nelson, anything else to add on the positives before we dive into the negatives?
No, I think we're good because it's a good seg actually into the negative part, because I wanted to expand a little bit on dividend cuts. And that's going to be the number one thing that I'm sure maybe not the number one thing, but it's definitely something that argument that I hear is in COVID, during the great financial crisis, even during the 2001, 2002 tech implosion bear market, there were a lot of companies that cut their dividends. And how does that impact a retiree at that point? And like, there are always going to be sectors that get hit during the downturn, and you won't be able to predict how that's going to impact your portfolio on a diversified basis. COVID was a true kind of black swan event. Nobody really saw it coming. And what you saw happen during COVID was that strong companies just freaked out and cut their dividends, and in a few cases eliminated their dividends altogether for a few months, and then slowly brought them back as the market recovered. So I don't know, there's never going to be a way to avoid dividend cuts completely, but when you look at the numbers of past bear markets, what you find is that dividends hold up better than stock prices hold up. And generally, dividends get increased for the most part, even during these tough times. Most companies are able to just go through, shrug, and especially if you're on the more boring side of things, like it's just like Coca-Cola going through COVID. Yeah, like it did hurt the business for a little while because people were going out to restaurants less and drinking less soda and so on. But the company, the business, it just recovered very quickly. So downturns are a fact of life when you retire. I think dividends, or focusing on the dividends, is an excellent way to get through downturns with the least amount of damage to your portfolio as possible.
Yeah, for sure. I guess talking about the negatives, a couple of things, right? So one would be, I hear this argument a lot is during your accumulating phase, you're paying extra dividends. So I'm talking about building your portfolio, you only using index ETFs such that you're only buying, you're not selling, and then the distribution is relatively low compared to dividends. So the argument is that, you're paying a little bit higher in taxes when you accumulate. I guess that's in some way true, but it really depends on your personal situation. So one of the things some people argue would be when you're accumulating, build your portfolio using index ETFs, so you get that growth. And then when you retire, switch over to dividend paying stocks. But I find that's wacky because then you're selling your index right at the moment you're retiring and switching over to dividends. And then you basically lose out on all the years of compounding and so on, right? I don't know. I think that's certainly, if you really want to get into the nitty-gritty, maybe during accumulating phase, you're paying a little bit more taxes, but I don't know. It's hard to say, especially when you're utilizing accounts like RSP, TFSA, and non-registered. The math is pretty complex. So I don't know if that's 100% true. So that's one. Nelson, you talked about dividend cuts, and I just wanted to add, that's why you hold multiple dividend stocks, right? If one cuts, maybe it only impacts a fraction of your dividend income each year, right? You don't want to have a company that paying dividends and that accounts for 50% of your dividend income. That's not a good idea, right? You want to spread it out. Now, the biggest negative that I have heard is that you're not as diversified when you do dividend investing and you're living off dividends, because you're essentially buying companies that pay dividend. You're not buying these like high growth stocks like the likes of Amazon, Tesla, and so on. I suppose NVIDIA now pays a little bit dividends, but it's still really low in comparison. So yeah, you lose out on these high growth stocks. You're buying more steady Eddie company, more mature companies. So that's one of the negatives. You may not see as much growth, but you're trading that in for the safety aspect. So it depends what your goal is, right? Like when you're in retirement, you're probably not trying to make as much money as you can. You're not trying to grow your portfolio from $1 million to $10 million. You're really trying to preserve that capital and try to have that capital last for the rest of your life, or sometimes even pass down to your kids or your grandkids, right? So your goal changes a little bit. Yeah, I think diversification is it's maybe one of the negatives, but I think it's over discussed.
Okay, I got a lot to say because just so mad right now that the whole thing of I'm going to invest in growth and then switch over to dividend stocks at some magic point in the future is such a terrible idea. And I'm urging everybody who is listening to this to just please do not do it. There's so many problems with it. The first is that you're creating this massive market timing event at some point in your future. You're going to have to make a decision to change you're changing your entire investment philosophy on a dime at some point in the future. And when are you going to do that? How are you going to make that decision? How are you going to, this could be like $1 million decision easily for a lot of people. Good luck with that decision. It is a terrible idea to put yourself in a position to have to make that position. And then on top of that, if you have assets that are outside of a RSP or a TFSA, at least in those accounts, if you do make that decision, you don't have a tax implication. If you sell everything, if you have growth stocks in your registered account and you sell them all at some point, or even if you slowly sell them as you get into your 50s and your 60s, you are creating taxable events at that point. And it's the exact same people who do not want to pay these small amounts of taxes on dividends that we talked about earlier, and yet create that taxable event in the future where they're going to have to pay way more tax in order to so you're just deferring the tax situation. But congratulations, you just pay tax later. And then on top of that, there is no guarantee that the growth stocks are going to continue to outperform, or there's no guarantee that the growth stocks that the hardcore non-dividend folks have chosen that they're going to outperform. So there's the potential in the future that you load all in on like Tesla and Nvidia, and next thing it's, when it comes time to switch these things over, I don't really have the gains that I thought I was going to because I bought them when they were too high or whatever. So I apologize for the rant. I just think that strategy is a terrible strategy, and it's not going to work. And if you do make it work, congratulations, you got lucky. Like you flip a coin and your coin flip worked out in your favor. So sorry, rant over.
Yeah, I think the biggest piece is that single event, or even you spread it out over the course of, call it 6 months or a year, you're still making that selling decision. And like you said, there's so many implications behind that, right? It's like the tax hit, you have to get your timing correctly. That's going to be a very tough decision to make, right? It's, do I sell it today? And then it's like, when you have money, do you buy into dividend stocks the same day, or do you have to wait? There's so many implications. It's just so complicated. I would just avoid that in general. And that's why whenever people suggested that, I'm like, yeah, okay, that's a good idea. But like you said, Nelson, you're just deferring that tax consequences down the road, and you're going to take the hit all at once. And switching strategies, there's always a mentality shift, and some people can't do that. So that's one. What other negatives can you think about living off dividends?
I was going to touch on the diversification one, because you talked about the like tech stocks and like not having those high growth stocks in your portfolio when it comes time to retirement. And I'm going to like pivot on that a little bit too, because that is a negative. And another negative is that if you are looking to do the tax implications we talked about earlier, they only apply for dividends that come from Canadian companies. If you're paying, or if you have US stocks in your like non-registered account, those get, I think it's a 15% flat tax, if I remember right, on those. Now, for now, I stick my US dividend stocks inside my RSP because that's the best account for them. But the other accounts, you will have to pay the withholding tax to the United States government. That is also a factor as well that you have to consider. Whereas if you're going to be 100% in Canadian dividend stocks that trade on the TSX, it may be difficult to get some international exposure from that kind of portfolio. Now, you can argue that you look at the top companies on the TSX, since we have like the top 6 Canadian banks, they all have operations in the United States. Most of them are like a little bit diversified on top of that. You look at the insurance companies, well, they have operations in Asia, Europe, United States, et cetera. So you do get some diversification from that aspect of it, but I don't think 100% get away from the kind of single country risk that is Canada. If we elect a prime minister, we elect a party, whatever, that kind of does some damage to the country and our stock market goes out of favor, then that international diversification will not matter that much. Bob, I know that you have via ETFs, even via some individual holdings, that you are diversified outside of Canada, as well as having some Canadian exposure, obviously, as well. Is that something that you've thought about as you've done that exposure? Or is it more of, hey, I think the United States is the world's best economy, I want exposure to that, or I want exposure to tech or whatever? What's that thought process that you went through as you built your portfolio?
Yeah, I think it's a little bit of both, right? And also, you mentioned a lot of these Canadian companies do operate outside of Canada, so they do have income coming from outside Canada, so they're not as exposed to the Canadian market as people think. Even you take the banks, right? TD is really big in the US. Royal Bank is diversified outside of Canada. But our jig is that we want to tap into the international markets because there are some big companies that we can invest in Canada. And then when you look at sectors like consumer staples, we don't really get that many names here in Canada. Tech, we don't really have that many tech companies here in Canada, or these big ones, right? So being able to tap into the US and also other international markets, that we feel is pretty important. And that's why we utilize both index ETFs like the XAW and QQQM to expose us to these international companies. We also hold individual stocks outside of Canada, the likes of Coca-Cola you mentioned, or BlackRock, Visa, just to name a few. So that our idea is just give us a little bit more exposure. So that's something you really need to consider as you construct your dividend portfolio. Now, just going back to the negative here, one thing that, and we touch bases, right? Like the yield now is getting lower and lower. One negative is you need a little bit higher capital than when you do 4% withdrawal rule, right? So if your dividend portfolio is yielding, call it 2%, you need double the capital than you have to when you do 4% withdrawal. Now, not in the world, but for some people that matters. So that's maybe potentially a negative. The other thing is people get into too much of the full security trap, right? They may buy a company and they don't pay too much attention to the company, and maybe the underlying business might be failing and they don't pay attention to it, and then they get hit by a dividend cut. And when typically when there's a dividend cut, then both the share price and the dividend fall, and then you're in quite a bit of loss. That's why you have to pay attention to your portfolio, the underlying businesses that you're holding, and so on. Right? So it's not something you can prevent. It's just you need to pay a little bit attention. Obviously, if you invest in index ETFs, you're paying that management fee to the management company, so they're monitoring that for you. So you're paying fees, so you don't have to worry about the underlying businesses. So you have to find some trade-offs here.
I believe that you mentioned the dividend yield and having to save more as a downfall. I think that is probably the number one downfall of a dividend approach, because at the end of the day, it's if you can figure out, say, like let's call it a dividend portfolio with a 3% yield. I think that's very achievable to get some decent growth on top of that. Okay, if you want to spend $60,000 per year between you and your spouse, you got to get $2 million in order to hit that. And the median Canadian ends up with about a tenth of that. It's about $250,000 that they retire with. So there's this massive gap between the two. And of course, the number that I have brought up with, it does not include any CPP or OAS. And of course, for you and your spouse, that would be quite a bit of sort of money on top of that. But so the point is that, like, it is a hard sell for a lot of people to get to the point where you have enough in capital in order to have that much in dividend income and not have to worry about the principal at all. It's just, hey, the principal is going to grow and I'm just going to spend the dividends, the interest. And that is a hard position for a lot of people to get into. And so what happened is that people take this philosophy and they say, okay, I'm not going to get $2 million, but I can get $500,000. And then I'm going to, rather than look for a 3% yield, I'm going to try to find a 10% yield somewhere and find a product that has that. And then you get into that issue as well. And of course, Bob, we have talked extensively about reaching for yield and how it's such a terrible idea. But for somebody who wants to retire early immediately or doesn't want to wait long enough to get to that amount, that's a trade-off that they'd be willing to be okay with until what hits the fan and all of a sudden that dividend has been cut. Ultimately, saving that much money is a challenge. It's going to be a challenge for most everybody. Yeah, 5 or 10% of Canadians are going to be able to do it and it's not going to be an issue. They're just wired different. But it is a tall task for most people. And I think that is a significant negative. Ultimately, I don't think that it's that big of a deal in terms of, hey, look, a lot of people aren't going to be able to accomplish it, and that's fine. It's like they need to do another strategy. Anyway, I don't know. Any thoughts on that?
Yeah, I think it's true. Your yield may be lower, but that's one thing you could do is supplementing your income with a small amount of withdrawal. right? So instead of withdrawing 4% from your portfolio, like the retirement rules that everybody talk about, maybe your portfolio is yielding 4% and you withdraw 1%. Again, that still puts you up pretty successfully, and your success rate overall should be much higher than withdrawing 4% from your portfolio. So there's different ways to do things, and there's not one size fits all. And yeah, you may need a little bit more principle when you do dividend investing and living off dividends, but that's the reason why you want to build out your portfolio over time rather than that one decision point that we just talked about earlier, where you sell your portfolio and switch over to dividend investing, right? So you want to build your portfolio over time, and really you want to take advantage of the market downturns and then really buy stuff that's on sale. That, again, patience goes a very long way when it comes to building your investment portfolio. Any other negatives, Nelson?
I think we've covered them in terms of diversification, and yeah, I can't think of any right now. So I don't know if you can think of any, Bob, or if you want to just pivot to our final thoughts here, just like on the overall strategy and how viable you think it is for the average listener, the average Canadian.
Yeah, I can't think of any other negatives. I'm sure listeners, if you could think of any, let us know. Maybe we missed some. I think generally speaking, it's all about what you feel comfortable with, right? Whether you're okay with index or dividend investing, or it could be a combination of both, right? Like what we do, we call it I think it's called hybrid investing. We utilize both index ETFs and dividend stocks, and that works for us. May work for others, may not work for some people. Ultimately, it's your personal decision.
Yeah, I like to think back of when, for a lot of my investment career, or whatever you want to call it, I was really just I was focused on just growing my net worth, and a lot of people are, I would say. And when you are looking at the idea of early retirement, or looking at that thought process, you pivot on the why a little bit. It's like you realize that your plan has every bit as much to do with kind of your own personal comfort level that it does math, and then it does like everything else. And, I know when I was thinking these philosophical things about like how I was going to implement this, what I really came down to is it's like I did not want to sell chunks of my portfolio to survive. Now, I would be open to potentially selling chunks of it in the future in terms of gifts for people, in terms of charitable giving, in terms of like maybe large purchases, etc. But like that was like a flexible thing that I didn't want to have to make those decisions in order to eat next week. And I think that that mindset is something that really meshes well with the strategy. So I don't want to sell. I want to just spend the dividends. Why? Because I want to leave a legacy. We don't have any kids. So for us, the legacy is giving to charity and to fund things that we think are important. So I think a lot of Canadians are in the same boat where they want to have something for the next generation. They want to make sure they don't run out of money. And dividends are a really effective way to ensure that happens. They're not foolproof, obviously. And some people will stretch for yield and do some of the things that we've told people maybe that they shouldn't do. So that's the goal. The goal is to not run out of money. And a very easy way to do that is to just spend the dividend. So I think it comes down to personality, and it comes down to goals more than math at that point.
For sure. And I mean, we could get into the whole, what's the best way to withdraw like RSP, TFSA, non-registered, but that's definitely require a little bit more math, and that's going to be different person to person. And in terms of timing and such, that will take a bit more discussion and such. And yeah, like how it works for you, Nelson, will be a little bit different for us. So maybe we don't need to get into that, but just know that generally speaking, living off dividend does work. I have had readers from my blog that reach out about how they're living off dividends, and they've been living off dividends for decades, and it certainly works. Some people don't really talk about it because money is a taboo subject, so maybe you don't hear it as much, but they're definitely out there.
Yeah, exactly. I agree. And there are thousands and thousands of Canadians that are just quietly doing it behind the scenes, and you don't know because they just look like regular retired folks or whatever that very quietly have these 7-figure portfolios, and you just would like they live very normal middle class lives. So anyway, Bob, any last thoughts here before we wrap it up?
No, we would love to hear what you think about living off dividends, if there are other things that we haven't covered. So leave us a note, either in the comment section or contact us via Twitter or X, or send us an email on our website or blogs. So yeah, we would love to hear you. And if you have any episode ideas, let us know. We would love to hear from you.
Yes, I think we're running out of episode ideas a little bit. So we would appreciate anyone's suggestions on that. As always, thanks for listening, and we will talk to you guys again.
If you enjoyed the show, make sure you subscribe to never miss another episode. For more from Bob, visit his site at tawcan.com. That's TAWCAN, all one word. Nelson can be found at CanadianDividendInvesting.com. They're both on Twitter as well. Just search for Tawcan or CDI Newsletter. Thanks. See you next time.